Let's move on to the pharmaceutical space now. We've got Sarabjit Kour Nangra from Angel Broking with us. A lot has happened in the pharma space. I mean, after the kind of regulatory warnings that we saw from the US FDA in terms of plant-specific issues, we've seen the EIRs also come through for some of those companies. We've been hearing about a consolidation buzz as well for something like a Cipla and a Vocard. There have been a lot of drug clearances also that have come through. So Sarabjit Kaur Nangra joins us from Angel Broking, and my colleague Hiral also joins us to steer us through this discussion. Good morning, Sarabjit. It's good to have you on the show. Let's start off with your view on the EIRs that have come through over the last month and a half. After the kind of strict and stern observations of the US FDA that we saw for some of these company-specific and facility-specific issues, how much of an upside do you think? I mean, I understand that there will be time for the EIR resolution to come through, but do you think that the industry is now looking up in terms of the regulatory overhang it faced for the year and a half previously?
These event risks are pretty normal in the industry by now. Everybody is kind of understood that these are event risks which come and go. So I think as an industry, even from the analyst point of perspective, we are matured enough now to understand these are events which happen, which are difficult to call out, but the only margin of safety you can have is a company which is more diversified, a company which is more less dependent on few plants, a company which is more in the niche segments, have good opportunities in the US space, and is available at attractive valuation. Because we tend to see that whenever pharma companies are doing well, their valuations tend to get higher than the normal or their fair valuations, and when event risk happen, eventually they come down also much lower than their fair valuations. So the only best way to play this sector has been over the last couple of years has been to get into the stocks when the event risk is predominantly heavy, and come out of and buy them at attractive valuations, and get out when the valuations become expensive or overboard. Because the growth in the sector eventually now will taper off. Growth was the key driver for the sector. Growth is going to slow down going forward. Only few companies which will manage is companies which are large cap with good cash flow in their balance sheets, so that they don't have to leverage much and still protect the ROEs and have good market share in the industry. So those companies are the ones you should look out for at any event risk that happens in the industry. So I guess the industry is playing out as expected now, since, as you mentioned, many of these companies are going to get out of the US FDA embargo, and hence earnings momentum will pick up from say FY 18-19 onwards. So we will see a good year, next 2 years of good growth because of base effect, and eventually a good stock performance, because these stocks are actually available at attractive valuation. So I guess that's the only way to play out, because these event risks come and go, and this has become a part of the industry now.
Good morning, Sarabjit. Fair point taken right now. But from an investor perspective, if I have to ask you, because currently if you go to see, investors are not really very comfortable with stocks that have a large exposure to the US as well as the Europe market. So in terms of where earnings visibility is concerned, as you said, we will see some play out that will come in from FY 18 onwards. Would you advise investors that it would be the right time to then enter the pharma pack now?
As you rightly mentioned, that entry point is determined the valuations. Now, if valuations, because of the event that has happened, if you look at Sun Pharma, that comes to my mind immediately. If you look at Sun Pharma, I mean, the stock has not done anything great in comparison to other pharma stocks. I mean, it's not delivered in terms of, I don't have an exact number on my hand in terms of its performance, but whatever I have seen, I don't think the stock has done that greatly, outperformed in comparison to its other peers like Lupin or other companies. So to that extent, and that has happened because of the event risk that's possible in the company. But that has made the valuation also attractive on the same side. So obviously, entry points are determined by valuation. That's the point I'm trying to bring out, that most of these companies, barring few of them, have reached a point where they have decent upsides available. So it's a good time to, some have good upsides and some have decent ones. So given the valuation and given that the stocks have corrected for the event risk that you're talking about, I guess it's a good time for long-term investors to get it. Though the growth will not be as high as earlier of 20-25%, but at least it will be still a sector of 15-18%, which is given that its ROEs, like Sun Pharma is earning on an average normalized earnings ROEs of around 25%. Even Lupin on a normalized ROEs can do easily 25%. I think a sector with 25% kind of 20 to 25% ROE growing 15-18% is a decent compounding, given that the valuations are attractive. So from that stand perspective, I think investors should start looking at the space now.
All right, Sarabjit, we'll leave it at that, but appreciate you joining us with your view of the overall sector. For dearth of time, we'll have to curtail this, but we'll continue our discussion on some other day. Thank you so much, Hiral, also for steering us through this discussion. With that, it's a wrap on this edition of Trending Today. Thank you so much for watching.